Okay, let's unpack this. Welcome back to the deep dive.
I'm great to be here.
Today, we're really digging into Adani Enterprises Ltd, AEL, looking at their H1 FY26 results, some big strategic moves announced recently.
Absolutely. And our goal isn't just, reading off the numbers. We want to get behind them, understand the story. AEL's in the middle of this really ambitious pivot.
A pivot is putting it mildly.
Yeah, moving from those established, sometimes cyclical trading businesses towards, massive infrastructure and green energy incubation. It's quite the shift.
And the headlines, they really back that up. Consolidated EBITDA for the half year, 7,688 crore. Okay, but the structural news that really blew the doors off.
The rights issue.
Yeah, the board approved this huge, partly paid-up rights issue, 25,000 crore, massive.
But here's the really fascinating part, the key takeaway I think you need to grasp. Those incubating businesses, the airports, the roads, the new energy stuff, they now make up 71% of AEL's total EBITDA.
71%.
Think about that. Last year, same period, it was 60%.
Oh.
So that jump, it basically validates the whole strategy. Building infrastructure at scale, and it's working, it's contributing.
That shift, 60 to 71%, that's pretty much the whole narrative right there, isn't it?
It really is.
But okay, before we get too carried away with the strategy, let's quickly run through the headline financials. The scorecard for the half year ending September 30th, 2025.
Right, context first. So while the strategy is playing out, the top line numbers did show some pressure. Total revenue was 44,281 crore. That's actually down 10% year on year.
Okay, down 10%.
And EBITDA also dipped by 11%. Profit before tax, if you strip out a big one-off exceptional gain they had, landed at 2,281 crore.
So seeing revenue and EBITDA down, that usually rings a few alarm bells, right? Where did that drag actually come from, and why should we still feel confident about the underlying business?
Yeah, good question. The source is pretty clear on this. The weakness was almost entirely contained within the older segments.
The primary industries.
Exactly. The hit to EBITDA came mainly from lower trade volume and price volatility in their integrated resource management. That's the big commodity trading and mining arm.
Ah, the IRM segment.
Yeah, and that was made worse by, ongoing geopolitical stuff messing with commodity markets globally.
Okay, so the older, more cyclical parts felt the global pinch. But the newer, capital-heavy infrastructure businesses, they kind of stepped up, stabilized things.
That's precisely it. And that's why that jump to 71% contribution is so significant.
Right.
Because assets like airports and roads, they tend to generate much more stable long-term cash flows, often linked to inflation too.
Makes sense.
So when 71% of your earnings base shifts into that kind of asset class, it fundamentally changes the company's risk profile. Makes it less volatile, more predictable for investors over the long haul.
That's the deeper story behind that 71% figure. Okay, let's talk about execution then. AEL always talks about incubation at scale and execution. Are we seeing projects actually finish and start while earning money?
We are. The list of completed assets is getting pretty concrete now. Proof that the big investment cycle is starting to pay off. The biggest one, undoubtedly, the Navi Mumbai International Airport.
The Greenfield one?
That's the one. Inaugurated October 8th, 2025, and it's set to start commercial operations basically now in Q3 FY26.
That's huge. What else? I saw something about roads.
Yep, they got the PCOD, this provisional commencement of date for the Nanasa-Pigan Road project. That makes it their 7th operational road asset. So adding steadily there.
Okay.
And don't forget Kutch Copper, part of the metal strategy. The first phase, 500,000 tons per year capacity, is fully commissioned now and ramping up production.
Right. So all these, the airport, the road, the copper plant, they should start kicking in sustained EBITDA from this quarter, Q3 onwards.
That's the expectation. The taps are starting to open on these big investments.
And the pipeline still looks packed, right? What's still under construction?
Oh, it's vast.
Yeah.
The Ganga Expressway, that massive road project, almost 90% complete, according to the update.
90%? Wow.
On the new energy side, ANIL, they're fast-tracking construction for another 6 GW of solar cell and module lines.
6 gigawatts. The scale is just huge.
It is, and they're pushing ahead with vertical integration too. The PVC project, 1 million tons per annum capacity, that's on schedule. Expected to add to EBITDA by FY28.
FY28, so a bit further out.
A bit further out, yeah, but it shows the long-term plan. Plus, they keep winning new work. Just got letters of award for 3 more roads and 2 water projects. Adds up to nearly 20,000 crore in the order book. The development engine is definitely running at full tilt.
Okay, so since these incubating assets are now, as you said, 71% of the earnings, Let's dive into the biggest one, airports. Adani Airports Holdings Ltd. 8 airports now, India's biggest private player.
That's right. Handling something like 23% of passenger traffic and nearly 30% of air cargo volume in India. It's a major platform.
And the financials look like they're really taking off, pun intended.
Yeah. The operational leverage is kicking in. H1 FY26 EBITDA for airports, it jumped 51% year on year.
Hit hidden count to 157 crore.
51% growth. And they're consistently tracking over 1,000 crore rupees in EBITDA per quarter now. That's a serious run rate.
That is serious momentum. I noticed the unit figures looked really strong, too. They seem to be getting better at making money from each passenger.
Absolutely.
Yeah.
You look at the traditional aero yield per passenger fees from airlines, etc., that hit 485, up 20%, which is good.
Okay.
But the really impressive bit is the non-aero income per passenger. That jumped 34% to 614.
Wow, more than the aero yield.
Exactly. That's things like, the shops, the food courts, parking, digital services. It shows they're really maximizing the value from the footfall, hitting all-time highs on non-aero penetration, turning passengers into customers very effectively.
And they're not slowing down. This acceleration of Navi Mumbai Phase 2 Capex, that sounds incredibly aggressive. 30,000 crore, starting next fiscal year already.
It is aggressive. They're not waiting the plan 2 years. It shows immense confidence, clearly.
But it also raises that question, doesn't it, for you listening? They're already carrying significant debt from Phase 1 incubation. Does pulling forward another 30,000 crore of spending that won't generate returns for years, does that put too much pressure on them financially in the short term?
It's the classic high-risk, high-reward infrastructure play, amplified. They seem confident they can manage it.
And maybe tech helps mitigate. They mentioned this deal with Inos for AI, agentic AI solutions for personalized support across airports. Maybe that drives efficiency long term.
Could be. That digital layer is becoming increasingly important. And speaking of digital, Adani partnering with Google on that AI data center campus in Vizag.
Right, India's largest, they said, tapping into that huge demand for generative AI.
Exactly, a smart adjacency.
Okay, what about ANIL, Adani New Industries Limited? Solar, green hydrogen, module sales look strong, over a gigawatt per quarter, but segment EBITDA was down 14%. What happened there?
Yeah, that was flagged. It seems to be mostly an external issue. Uncertainty around potential U.S. tariffs.
Trade policy uncertainty.
Right. It forced them to, rationalize their pricing in the short term to stay competitive globally. So volumes are healthy, but margins took a temporary hit. Management expects it to normalize over the next, say, 18 months or so.
Okay, so a pricing adjustment, not a demand problem.
Yeah.
Understood. And the really big bet, green hydrogen, where are they in that?
They reiterated that all the pieces are basically in place: land, manufacturing capability, port access, all secured. But they're being cautious, actually. They're waiting for results from their pilot projects, which they expect around the middle of next calendar year. Only then will they make the final huge investment decision.
So despite the ambition, there's some discipline in the capital allocation, waiting for data.
Seems so, which probably brings us to the rights issue.
Yes, the 25,000 crore elephant in the room, massive capital raise. What's the strategy here? It's not just about raising cash, is it?
No, the primary goal, they state, is strengthening the balance sheet. And there's a really elegant mechanism here involving shareholder loans.
Right, about 20,000 crore of existing loans from the family shareholders are being converted into equity through this rights issue.
Exactly.
Okay, walk us through that in simple terms. Why swap a family loan for public equity? Why is that strategic?
Well, think about it this way. Even if it's a loan from family, it still sits on the balance sheet as debt, gross debt.
Right.
By converting those loans into equity permanent capital, they essentially wipe out a big chunk of internal liability from the official debt figures.
So it improves the debt ratios, looks better to lenders, rating agencies.
Precisely. It cleans up the balance sheet, reduces the headline gross debt number significantly, and strengthens the overall leverage profile. So kind of a de-risking and strengthening move, all in one.
Got it. So it's partly a tactical cleanup, making the books look healthier, and the rest of the money raised, the other 5,000 crore or so.
That's pure growth capital. The sources say it's primarily earmarked for that accelerated growth in the airports business over the next year, plus supporting needs in roads and the new industry segment.
So directly funding those 71% growth drivers we talked about.
Exactly. Fueling the incubation engine.
Okay, one more technical point I want to clarify, because it could look alarming if you just glance at the cash flow statement. Operational cash flow, CFO, was down quite a bit year on year. Why isn't that a panic signal?
Yeah, this is where context is absolutely crucial when reading financial reports. The CFO took a hit almost entirely because the Kutch copper plant shifted status.
Shifted from work in progress to operational.
Correct.
How does that affect cash flow so much?
Well, when a massive plant like that starts up, you suddenly have this huge one-off need for inventory and working capital.
Ah, you have to stock the shelves, basically.
Exactly. Before you can sell copper, you need to buy and process the raw materials, build up some initial stock. That initial outlay consumes a lot of cash right at the startup phase. It's a temporary drain on operational cash flow.
So it's a timing thing due to the plant starting up.
Precisely. Management actually points to a different metric, operating profit, before working capital changes, which barely change year on year. That gives a clearer picture of the underlying operational performance once you factor out that big one-time working capital adjustment for copper.
Okay, that makes sense. It's an accounting and operational startup effect, not a sign the core business is suddenly bleeding cash. Good clarification.
Important nuance.
And finally, just a quick note. Amidst all this high-octane growth, they did pick up some ESG recognition. Great Indian ESG Organization of the Year 2025, and their Sustainalytics score improved. Still medium risk at 25.9, but trending better.
Yeah, they're keen to show commitment on that front, too. So wrapping it up, this deep dive really confirms AEL is deep into this defining transformation. The earnings are clearly shifting dramatically away from that cyclical trading base towards these stable, long-life infrastructure assets. That 71% EBITDA contribution number says it all. They're morphing from primarily a trader to primarily an asset owner and operator.
And the sheer scale and honestly the speed of execution, it's kind of breathtaking.
It really is.
I mean, when you think about one company accelerating a 30,000 crore Phase 2 airport expansion while also building India's biggest AI data center, it feels less like just company growth and more like they're actively trying to pull forward India's national infrastructure timelines.
Which leads to maybe the final thought for you, the listener, to mull over as you watch AEL going forward.
Yeah.
If Phase 1 of these incubated assets, like the copper plant, like Navi Mumbai Phase 1, if they're only just starting to contribute significant EBITDA now, how profoundly will that 71% incubating contribution reshape the entire group's risk, its earnings power, its valuation profile over the next, say, 5 or 10 years? The heavy lifting, the deep investment phase is starting to yield results. The next decade could really show the full impact of this massive strategic bet on infrastructure.
A fascinating question to end on. A lot to track there. Thanks for diving deep to the sources with us today.
My pleasure.
We'll catch you on the next Deep Dive.